How to remain resilient in a volatile times. By its very nature, the stock market is volatile. It's like a human pulse. There are always ups and downs. Volatility in the market is both inevitable and an unexpected phenomenon. It's unexpected because even the most successful stock market investors and traders do not know what to expect and when. And it is for this reason anyone can make money in the stock market, similarly as the case with anyone can lose money too. If you want to earn better returns by taking lesser risk, consider ET Money Genius and get personalized portfolio allocated based on market conditions. More on ET Money Genius at the end of this video. Hello everyone, I'm Rakshit Pai, and in this video I'll give 5 such instances where the market will correct and even the worst case, a crash too. What exactly is a bear market? A 20% drop in the stock market is termed as bear market. It's when people panic sell. That's when there are very few buyers in the market. Those left are either unaware of what to do or know exactly what to do. A bear market brings a lot of hard times. All your portfolio returns turn negative and it seems as if all hope is lost and the economy may never recover fully. From our current highs of 18,100, the Nifty has dropped by a little over 6%. So it's easy to say that we are nowhere near a bear market. It can also be said that a lot more trouble is on its way before we realize that we are in a market correction. Anyways, we are not here to anticipate or predict market corrections. However, we can try to analyze what makes the stock market to correct. So what leads to such a drop? Here are my top 5 reasons for market corrections. Number 1. Economic policies. Economic policies such as taxation, government budgets, the money supply and interest rates, as well as labor market, nation's political and religious policies, and many such other areas of government interventions into the economy directly or indirectly will lead to market correction. If economic policies can make an economy stronger, the same policies can also make it weaker, and hence we can expect the stock market to correct. Economic policies are national issues. When it comes to international one, then we have number 2, geopolitical concerns. With globalization, we can easily say that each and every country on the planet is as free as it is dependent. It doesn't make sense, right? Well, with globalization, countries have opened up for trade and commerce, but they have also started consuming something from each other. For instance, we all buy and sell goods and services to one another, and if your trade partner is having trouble with their economy, you can expect the same to have a ripple effect on your economy. For example, in our recent video on information technology stocks, we analyzed why IT stocks were falling. And one of the most prominent reason was that the Western countries were spending less on IT. Watch this video, link in the description. Number 3, recession. A recession is when an economy contracts 2 consecutive times. It's when our GDP figures drop for 2 quarters. A widespread recession happens when there is a widespread decline in spending. Why do people and companies spend less? Well, it's when the credit cost has increased. Why is borrowing cost has increased? Because the country's central banks have hiked interest rates. But why did they hike interest rates? Well, because inflation was high and the only way to curtail high inflation is by raising interest rates. Now, where does this lead with the stock market? Remember how I said that a recession means less spending? Well, when people stop spending, companies stop making money. So you're left with an overvalued company with dropping revenue, and at some point the market will notice such situation and starts correcting. Number 4, war. Do I really need to explain why war is bad? I mean, we are seeing what is going on with the Russia-Ukraine war, right? With war, we have something called imported inflation. It's when even those countries who have nothing to do with war will face inflationary pressure imported from outside because each and every country's trade is dependent on one another, or so it seems. For example, the current war situation has hiked crude oil and other commodity prices. This hike will affect everyone. For instance, the cost of raw materials for companies producing anything and everything will rise. This cost will be borne by customers who will reduce consumption, which will impact companies' revenue. Well, you get the picture, right? Number 5, natural calamity. A natural calamity can be anything like an earthquake, tsunami, flood, drought, etc. It's something out of our control, but impact on economy can be dire. Our neighbor Pakistan, for example, is experiencing its worst flood in history. The same will have a very severe impact on Pakistan's economy, and which will also cause its stock market to correct. Conclusion. What's common in all the situations mentioned is that people start losing hope on the economy, the leadership, and the way the country is heading. Something happens and it's the pessimism that follows that leads to a stock market correction or even a crash. Remember, stock market is a tool used to sense mass public sentiment. It's a voting machine for optimist and pessimist. One who punches hard to vote for what he wants will get it. Right now, the pessimists are punching in their votes. Soon, the bulls will be back. Have hope and invest for long term. I believe the video was informative. If you think so, consider subscribing to this channel. And here's my take on the ET Money Genius. Hi there. Do you take stock tips? Invested in them? Lost money? Well, instead of repeating the same mistake, earn better returns by subscribing to ET Money Genius. ET Money Genius will understand your risk profile and suggest different investment options for varying time periods, thus helping you build a very well diversified portfolio. High quality stocks that yield better returns are chosen so that you need not wait for years. So what is the expected return? Well, if you had invested as per the ET Money Genius high growth stock strategy for any 7 years in the last 15 years, you would have earned 22.4% CAGR. The wait ends here because with no additional work, you can earn a wonderful return just by subscribing to ET Money Genius membership. Check the link in the description. Thank you for watching.